Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.
Welcome to Stockwatch with me, Simon Brown, and joining me to unpack your stock-related questions today, Ricus Reeders, PSG Hole-in-One Ruimsig, and Cobus Potgieter from Southern Cross Capital. Be sure to send your questions through email stockwatch@bdtv.co.za, SMS 41392, or on Twitter at Business Day TV, #Stockwatch. Gents, appreciate the time. Notwithstanding a market that is sanguine and being polite here, Ricus, credit upgrade on our debt on Friday. I mean, it's one step in many, many steps we need to take, but frankly, we will take it. It's one in the right direction.
Yeah, first time in 20 years. I wasn't even middle-aged at that stage. So, as you said, Simon, yeah, it's indicative, I think, of hopefully positive sentiment returning not only to our side of the business, which is the stock market, but to economic circumstances in the country in general.
And Cobus, perhaps to me the telling point was you also got a positive viewpoint. In other words, positive outlook. They could technically, S&P could push us another notch up next time they meet. Because to be clear, we're still 2 notches in junk.
Yes, absolutely. And just to underline the upgrade from S&P, Moody's, who was the last one to have withheld comment, also reiterated the positive outlook later this morning. So yeah, altogether, certainly, I think, I guess one needs to understand that once you bottom out and you hit that turning point, it takes a while.
Yeah.
It takes a while for the sentiment to really turn, but I'm seeing a lot of cautious optimism, a lot of qualified optimism. All of these rating agencies keep reiterating there will be a little bit of short-term pain off the back of the new inflation target because, of course, of that strained base effect and delays in the wage deals. That will continue to now be higher than inflation for a couple of years, which will be painful. And then, of course, fiscal reform that needs to continue. It's all qualified, but it's certainly looking up relative to having this conversation probably a year ago.
Yeah, 100%. A year ago was load shedding was over a year ago, but of course we didn't believe it at that point. Now we're kind of like, hey, maybe it really is 18 months later. Let's get to some numbers. Cobus, Astral results. Really, this is a classic story of 2 halves. H1 was a bit of a horror show. They had negative operating margins on their broiler business. H2, sort of an Astral of old. And if that yellow maize price can hold, perhaps even improve into next year, perhaps looking decent. Your thoughts on the numbers and the prospects here?
I'm so happy you brought it up, Simon. This is one of my first calls and one of my first times on your show. And they were sort of on the thesis that, we'd seen the worst. They were in the previous set of results still affected by load shedding, and these chicken producers were severely affected by load shedding. It just massively increases their costs and, of course, adds to losses. And they'd suffered some headwinds in the form of things like influenza and the like. And on top of that, we had a very buoyant maize and grain price overall, which, of course, is a major input cost into their feeds business and then a major input cost into the chicken business as well. So while those average prices have remained high, they've been managing to push those costs onto their customers, and at the same time, it has normalized and come back somewhat. So that's very supportive of the feeds business. Now you're talking higher selling prices and lower input costs, and at the same time, the chicken business has performed significantly better in a market that is normalizing a little bit. So perhaps not. It's one of those recovery stocks where, like you pointed out, once we return to normalcy, there's a really nice return on the table, and it remains well priced. Actually, there's probably more upside from here.
Ricus, your thoughts on the results and I mean, a disclaimer we must always put on these sort of stocks, they are cyclical.
Very much so, but let's face it, even with all that cyclical price movements in the Astral share price, it's the first time it's gone above about 220 Rand in 5 years. And the trend is still up. So I agree with Cobus. It remains a trading vehicle because chicken is a strange business in South Africa. The moment things go well, you get a sudden influx of smaller suppliers into the market and they all disappear when that cycle turns. But for the moment, the going looks good, both from a price momentum point of view and obviously also from the fundamental viewpoint as Cobus has just described.
Ricus, car results out. The trading update of back in October certainly spooked the market. Results, I mean, they mention the cheap Chinese new vehicles hurting them. That'll help in time when they start becoming second-hand cars. They talk around getting through 16,000 units per month, which has been a near-term target for them. Your thoughts on the numbers and prospects? I mean, it was a stock priced for perfection. Is it now perhaps offering opportunity or still expensive? Ricus?
Yeah, it's a bit of bread today and jam tomorrow, as you said, as far as the second-hand car market in the cheaper Chinese models are concerned. And they're quite correct. I mean, those will return to their shop floor at some time in the future. It's the timing of that's, I think, is the question. So for the moment, the margins, I think, will remain under pressure while we wait for that fundamental change in the company itself. I still think that if we see substantial further weakness in that share price, I still think it's a great business model. It's not as if they are going to, or shall I rather say, I don't think that market for them is going to disappear. But yeah, it's probably moving towards a more sensible price, but I wouldn't be selling it just because of one set of worse than expected results.
Cobus, your thoughts on rebar cars? And certainly, I mean, the new car, well, I'm thinking Combined Motor Holdings, I'm thinking Motors have been doing fairly well. They, of course, sell the cheap Chinese cars. Cobus, your thoughts on the rebar cars?
We, look, in the wake of when sort of fundamental shift in terms of consumer behavior and the post-COVID, where a massive portion of the market downtraded to the South Korean imports that were significantly cheaper, maybe not buying fewer cars, but buying cheaper cars. We're sort of seeing that recur again. And rebar cars ultimately flourished in that environment, so I expect them to adapt again. That being said, part of what we are seeing is an increase in the number of units they are dealing with, and they're having to gear up. And we've seen a significant increase in the head office cost as relative to the increase in revenue, which I guess the market isn't particularly fond of. But that's the reality. You're going to increase the number of units whilst your revenue and perhaps your margin comes under a bit of pressure. But the thesis for the stock remains intact. It's a massively segregated market. They will, almost click-like in that, cobbling together this disjointed market. It's one of those things that is anticipated to scale very well and to get bigger and better as it gets bigger. So I think it remains intact, and like you've pointed out, one set of disappointing results. I wouldn't even call them poor. They're still great results.
Sure.
It's just disappointing relative to those lofty expectations you mentioned. Shouldn't put one off. I think this is still a cool hold for me.
Question came through immediately after the Naspers update of this morning. Next, Cobus is on your show. Please ask him, because it was his stock pick a few months back. Our viewers are paying attention here. Cobus, not a bad set of earnings from Naspers. It still is a good entry into Tencent/China. I can't imagine much has changed from your thesis of a month or two.
No, this trading statement doesn't. I mean, for a holding company, it's pretty useless. They reiterate, substantial increase in core headline earnings, driven mostly by Tencent, but also these e-commerce assets that we really like. The thesis remains intact. The Prosus discount to Tencent is a little bit narrower than it used to be, but it remains a great hold and a great diversifier. My preferred vehicle at this stage is Naspers, which is perhaps not as cheap relative to Tencent as it used to be, but it is very cheap relative to Prosus at the very least. So you're getting call it a 20% discount to Tencent out of Prosus, and an additional 11% out of your Naspers. So that just makes for a really nice cheap entry point. And we've seen in their buybacks, that continues to remain supportive for those shares. They've really shifted to buying back more of the Naspers relative to the Prosus.
Yeah.
So that creates a nice underpin. And of course, I still like Tencent. So what's not to like from getting it cheaply?
Absolutely. Ricus, for you, I mean, it's the Prosus has got other businesses now, but it's still predominantly Tencent. And Tencent, you're getting it at a discount. Your thoughts on the Naspers or perhaps Prosus?
No, I've said it many times, beware of what the Chinese government can do, but let's assume that they're not going to go insane, as they previously had. Then just looking at these results, I thought they were pretty good. There's still, I think, the difference between operational and bottom line. I think there's still a lot of getting rid and resizing and rectifying some of the damage done by Bob van Dijk. So don't forget about that. But I think with current management on track, and specifically on the non-Tencent business, that looks a heck of a lot better than it did 12, 18 months ago.
Yeah, agrees on that. We can absolutely agree on that. Let's get to some Friday numbers. Richemont results. Ricus, we talk luxury on this show often. There is, of course, LVMH, there's Race, there's Kering, there's Richemont. My sense of the Friday numbers really was them saying, yeah, and then there's Richemont, who sort of just sell, they don't do whiskey and handbags, they just did expensive watches. And those Friday numbers were good on what was a bad down day. The stock did 4.5% up.
Yeah, you can probably still see me smiling. It's been a stock pick of mine, and the watches part didn't do well. I mean, I think that's nothing new. But if you take a look at their margins for the other side of business, that's what I've been hammering about, that they had more room to maneuver than your other luxury stocks, and that came through. And that, in other words, increasing their margin and on pretty good revenue numbers. Market liked it, I like it, and I still think it's a buy.
Cobus, for you, some very over-expensive jewelry?
I've held this one, but we have been reducing exposure over the last couple of days. Call it profit taking. A little bit bearish on I realize the masonry business has done very well, and it's been a great diversifier relative to an LVMH, as an example. These results were disappointing a couple of weeks ago. But I'm a little bearish on the outlook for the Asian consumer. And it looks like, China's in a bit of a deflationary environment, published statistics notwithstanding, which generally doesn't bode well for the consumer's purchasing power. So, I guess it does bode well, but it doesn't bode well for their purchasing behavior.
Okay. We seem to have lost Cobus there. I had a couple of questions coming in, gents, late last week, early again today, talking around more American markets, but worried around American markets looking toppy. We've seen some pressure. To be clear, I mean, it's a couple of percentage points off all-time highs. And that if that starts to unravel, the follow effect onto our local market. Cobus, let's start with you. How much do you, as a local investor, look at US markets because of that old cliche, get sneezes and the rest of the world gets pneumonia?
Yes. Look, I've been catching myself out in the call it dislocation or decoupling argument of late because of this hypothesis around the so-called debasement of the US currency and the buoyancy we've seen in EM fixed income in particular over the last 6 months or so. But we do watch the market, of course. It's impossible not to. It is such a massive proportion of the world equity markets, so it feeds into activity elsewhere. I am, of course, very, very cautious more generally of the AI stocks, where the valuations seem incredibly stretched. So even though we are of the opinion that the environment remains reasonably conducive to equity valuations more generally, those stocks are particularly overvalued, and we have been reducing exposure there. There are some great, US companies that are not trading at ridiculous valuations that make for more attractive investments. We've been. I agree. The market seems toppish. I don't think we in all likelihood set for a crash, but a healthy correction wouldn't be unwelcome before perhaps dabbling in those expensive names again.
Ricus, for you, I mean, some of them are. I was having a look at, for example, Alphabet. I mean, they've actually got a negative net debt because, well, they don't have debt and they have money. Sort of scenario. How are you looking at US markets and sort of thinking relative to that, bringing it back home?
Well, yes, it will influence our market, even though it might not have anything to do with our market. It's just the way it works. As far as the American market itself is concerned, I think this has been the most written about and talked about bearish market outlook as far as US markets are concerned. Everybody knows, everybody is talking about it, everybody's writing about the risk associated with these markets. Yet we see dips being bought, we see huge volatility sort of increasing and then dissipating. And I think a lot of that has to do with A, machine trading, and B, the effect that leveraged ETFs in the US has on market movement. So you might sit as a carbon-based being over here saying, well, this is overvalued, undervalued, but you're getting such a lot of literally machine trading going into those markets where an extreme volatility spike to the one side just brings basically automated trading back into the market, buying that is difficult to, on a very shortened basis, say, well, this is now a crash or this is now a correction or anything like that. So I think it's difficult to see the signal through the noise at the moment. But I think we are all aware of exactly how precarious some of these valuations can be should revenue or income 6, 12, 18 months from now start disappointing. So it's good to be on your toes, but just selling because you are scared or because you think you're prudent, you might be shooting yourself in the foot by not exposing yourself to further gains in what is a generational change as far as markets are concerned in the form of the influence of what AI is going to have on society.
Yeah, and I take your point. Exiting because you're worried you can miss up on so much upside, and then it does come back, and it comes back to a level higher than where you exit. Let's get to the 91 results that came out. I had a quick look at them. I thought these aren't bad numbers. The market says I am wrong because they've marked the stock down some 2%. Ricus, your thoughts on the 91 numbers and potential? It's been a favor on this show, and to be clear, it's went from 30 to over 50 over the course of the year. Ricus, 91 for you?
I think that explains part of today's little drop. I mean, they are 40, 50% up from their lows. I thought the results were good. I like what's happening with their distribution channel, their strategy as far as emerging markets, where they were, I think, overweight versus peers. They're quite satisfied with it, and it's starting to work with them. So, yeah, I think a bit of price weakness on results, but certainly not because they were poor results, maybe just a bit overcooked and coming back to hold levels, if I can, or even viable levels.
Yeah. I mean, to your point, they're up over 50% off those Liberation Day lows back in April. Cobus, 91 for you?
If I'm bullish asset markets in general, I should be bullish, a high-quality asset manager that has recently done a deal with Sanlam, which just incentivizes them, gives them enormous distribution. And in these numbers, we have barely seen any effect from that Sanlam tie-up. So generally, I continue to like it, and this is barely a correction off the base of what I suppose are lofty expectations. The thesis for 91 remains intact.
Yeah, no, and I take your point. And nothing goes in a straight line. We say that all the time. South Sea listing, we got some details, we got some price ranges. Cobus, is it a listing that interests you?
It certainly does. I need to read through this prospectus in more detail, which I haven't had a chance to yet. But it's nice to see this turnaround play come to market, and I've liked it inside of blue for the last year or so already. It was clear that the new MVNO model, low touch, essentially white labeled cellular solutions, great business model. And I believe in the MTN update we saw this morning, where prepaid locally remains under pressure. A lot of that is Capitec with its very impressive distribution channel having their lunch. And Cell C is the back end provider and partner to Capitec in that space. So I really like it. I haven't had a look at the valuation yet, so I don't. At this stage, I still hold blue, but I'll take a view on the valuation for Cell C itself in future.
Ricus, for you, some South Sea?
Yeah, let's see what happens with the listing. I don't normally get involved in IPOs because there's just too much noise, frankly. But yeah, it's certainly a different business model from the Vodacoms and the NTNs and Telkom in form of the line asset managers. So it's a different way of getting exposure to that market. And as Cobus said, looking at MTN's results, Vodacom's update, Telkom's, I think that sector is still pretty much positive. So this is another way of going into it, but let's see what happens after IPO.
Question came through over the weekend to me. SA clothing retail. Surely there's some value here. Does the panel have a preferred? Ricus, for you, clothing, I think you're a Pepcore man, if I recall.
Yeah, still as easy as that.
Cobus, for you, you look a little more
Pepcore.
dapper than Pepcore.
Yeah, Pepcore, Mr. Price, high quality, excellent management, well positioned for growth or expansion in the economy. Absolutely. If you want a punt, if you want geared exposure to the upside, go to the financially distressed Fushinis. They are everywhere. They have the exposure. If we see a recovery in the SA consumer and a recovery in GDP growth, quite frankly, that share price will expand rapidly. But it does come with the risks of what is frankly a strained balance sheet at this stage. Yeah. But yes, I think it's a nice enough call at present valuations. I do like them. I think there's value in both Fushinis and Truworths, but they're not the quality plays that Pepcore and Mr. Price are.
Quick before we go to breaks, question come through. With the US lifting tariffs on citrus, is there opportunity, maybe impact because they do the cartons, maybe the Cull Group? We actually saw some really good numbers out a week or two ago because of the massive shipments ahead of tariffs. Do you look at like this and think or is it kind of in the price, or perhaps even just too small for these? Sure, Impact sells lots of cartons, but I don't know if it moves the dial if we ship a little more oranges to the US. Cobus?
They certainly did complain about this in their poor results, but I think, as you allude to, the impact is perhaps smaller than expected, and certainly smaller than we'll interpolate when we look at the broader media headlines. This is generally positive, and it makes sense because tariffing. The idea behind the tariffs is ultimately to stimulate local production. Yeah. But these seasonal fruits cannot be produced outside of season, so it just makes sense to import them when they're out of season, unless there's some other geopolitical play going on, or you've got a partner that you prefer over South Africa. Yeah. But it's a great outcome for the citrus exporters and the macadamia nut exporters. I think we still export significant table grapes to the US as well. It's also a seasonal produce, and hopefully the same dispensation will come through for other relevant exports as well.
Yeah. Okay, we're going to go to stock picks. We'll get your take on that, Ricus, next time. Ricus, your stock pick this evening, Sirius.
Yeah, it came up with results. Headline earnings per share down 28%, but it masks about 50% plus increase in operational earnings, and that difference is just currency loss because it is pounds, unfortunately, and pound hasn't been doing that well. But I think they are still executing extraordinarily well in their model, whereby buying underappreciated industrial assets outside of major business centre and improving them into a mature type of asset, selling it forward, and they continued strategy of looking at government, shall we say, aided defence and industrial parks, still executing very well on that. Price has been going nowhere, but at some stage I think this type of operational earnings and the history and consistency of that should be coming through in the share price, so I'd be buying that up on any price weakness there is.
And Cobus, we actually had a question around, is there any value in the local banks, maybe an ABSA or a Nedbank? And your pick today, Nedbank.
Yes, it's the purest play. South Africa's been upgraded. The government bonds hit records today. And historically, these things are highly correlated, the yields on the banks and the yields on government debt. And this particular rally, we've seen significant offshore buying in government debt, but not in the banks, not in the local banks. That's quite unusual. And just given everything else and the sort of bullishness, I guess, that I've allowed myself to express today, these banks just look like a absolute screaming deal. So a little bit boring, but Nedbank, call it the beaten down of the big four. The purest SA only play. I love ABSA as well. Its two largest markets, South Africa and Ghana. I'm quite bullish on their outcomes as well. There as well, you've got dividend yield higher than PE. Yeah. Same thing with Nedbank. So I think eventually either these bonds need to get more, get cheaper, or the banks need to get more expensive. You can't have this location forever. So I think it will be supportive for the banks.
Yeah, as is pointed out oftentimes in this show, those dividend yields are more than you get for putting money in their bank accounts, in their savings accounts. That's all for Stockwatch today. Thanks to our guests, Ricus Reeders, PSG Hole-in-One, Ruimsig, Cobus Potgieter, Southern Cross Capital. Up next, the close.
Stockwatch is brought to you by Merchant West. Where others stop, we push further. Because we believe business as usual doesn't lead anywhere new. Go beyond with Merchant West. Finance, invest, insure.